Break-even point analysis. So in this introduction, we will see what is break-even point analysis. What is break-even point? Break-even point is the point at which the total revenue cost comprising of fixed revenue cost and variable revenue cost equal the total sale value, or in other words, there exists no profit or loss. So it's a point where there is no profit or loss at which total revenue cost comprising of fixed revenue and variable revenue cost equal total sale value. So that such a point is actually called as the break-even point. Now, break-even point, some points to remember is about fixed cost, variable cost, contribution, and margin of safety. So what is fixed cost? Fixed cost remains constant no matter how many units gets produced or consumed. Fixed cost does not include cost for fixed assets. This will not change with changes in the level of sales. Examples are depreciation, rent, etc. Now, what is variable cost? So these cost changes according to the level of production, turnover, and includes costs meant towards raw materials, packaging materials, wages of labor, fuel and power, etc. So this cost varies according to sales, which means with increase of sale, this cost also increases. The variable cost increases, and with decline in sales, this variable cost also decreases. So that's about variable cost. Next is contribution. What is it? It is a difference between selling price per unit minus variable cost per unit. So remember, it is the difference between selling price per unit minus variable cost per unit. In other words, it can also be defined as total sales minus total variable cost. And lastly, it's margin of safety, which is the number of units above break-even point or units. Now let us see what are the basis of break-even point. So break-even point can be seen on the basis of turnover or sale. Break-even point can also be seen on the basis of number of units as well as on the basis of installed capacity. So first we'll see break-even point on the basis of turnover or sale. So on the basis of turnover or sale, suppose the break-even number of units is 2000 and the selling price per unit is rupees 30. The amount of sales for break-even level is rupees 60,000, which is 2000 into 30. So that is on the basis of sale. Now on the basis of number of units, suppose the present output of a firm is 3000 units per annum. Selling price per unit is rupees 30. The variable cost per unit is rupees 20 and fixed cost is 20,000 rupees. The break-even number of units would be 2000, which is fixed cost per contribution per unit, where contribution is selling price minus variable cost. It means that at 2000 units, the cost and sales revenue at break-even point will be equal. Lastly, on the basis of installed capacity, what is break-even point? Here we define a term break-even capacity utilization, which is break-even point units per utilized capacity, which would be 2000 by 3000 into 100, which is about 66.66%. So that is basically break-even point now for 3000 units. For installed capacity of 6000 units, the break-even point is calculated to be 33.33%. So these are some of the bases on which break-even point is calculated. We saw it is calculated on turnover, number of units and installed capacity. So lastly, it's break-even point, the different terms used. One is margin of safety and the other one is profit. Margin of safety is actually the units sold minus break-even point. That is, in the previous example, if 3000 is the present capacity of the firm, 2000 is the break-even point, then it is the difference of these two, which is the margin of safety. So it is whatever units which get sold above break-even point is taken as profit actually, which is around 1000 in this example. And profit, what is profit? So this is defined in terms of margin of safety units into contribution. So in the previous example, it is 1000 into 10, which works out to be around 10,000 rupees. So this completes a session on break-even point analysis. Only the fundamentals of break-even point analysis. Thanks.